Guys, I know why you're here. You're looking for that next big stock, the one that's going to crush the market in 2026, right? Now, here's the good news. We're going to show you 6 stocks that Wall Street believes has the potential to beat the market in 2026. And the best part, we're going to walk you through how we analyze them and the price we'd pay for each one. This is what we do at Everything Money. We teach you how to fish. Because the truth is, once you learn how to value a business, finding the next winning stock isn't a guessing game. It becomes a system, a process. Just like buying a house or a used car, you learn to ask the right questions. What am I getting? What am I paying? What's it worth? Now, here's the article from Business Insider. They put out this article, buy these 6 stocks to crush the market in 2026. And it's based on the picks from Nancy Tengler, the chief investment officer managing $1.6 billion. That's a big job. That's a lot of money. Her firm put out a list of 6 stocks they believe will outperform in the new year. Walmart, AMD, Tesla, CrowdStrike, Quanta Services, and D.R. Horton. Now listen, I want to help you think like a real investor. I don't want you to just follow the headlines. Because the thing that most new investors miss, just because someone says a stock is great, doesn't mean it's a good deal at today's price. There is a big difference. Let's start with Tengler with what she's saying. CrowdStrike, great cybersecurity firm riding the AI wave. It is up 48% this year. Nancy says it's expensive, but worth it. Quanta Services. Now, this is an interesting one. Not a household name, but Tengler sees it as capitalizing on electrification, AI data centers, and domestic manufacturing. Infrastructure is a long-term tailwind, and this company's earnings are absolutely compounding. D.R. Horton, a home builder. A bit of a curveball, but she's betting on a 2026 housing rebound. First-time buyer credits, builder incentives, and lower rates. Walmart, great company. They're growing their e-commerce, they're using AI, and they're appealing to all income levels. I've always said, you can go to walmart.com and buy a $150,000 Patek Philippe. AMD, solid player in chips, and they're betting big on AI inferencing. Fancy word for how computers apply what they learned. Tesla, Nancy says, don't worry about the valuation, buy it for Elon's vision. Let's just pause there for a minute, guys. Here's how I look at this. We're not just buying stories here. We're buying cash flows. The price you pay matters, and it matters immensely. Tesla might be the future. But if you pay $200 for $1 of profit, you're not investing. You're daydreaming. Because remember, price is what you pay, value is what you get. Every investment you buy, the returns are going to be based on all the future cash flows you get being brought back to today. If you're able to learn that lesson, you will stop chasing and you're going to start building real wealth. And if these stocks end up being great buys, awesome. But we'll let the numbers, not the headlines, tell us that. Remember, guys, she has no idea what's going to happen in 2026. No one does. That's not what we're here to teach. We're not here to teach you, buy these companies in between January 1st and December 31st, they're going to do awesome. We're here to say, certain companies make sense financially, but I don't know when the market's going to realize that. Remember, I was betting on Baba for a long time before it finally started to turn around. You look at these companies, look at Sprouts Farmers Market. These companies take time, and we don't know when that time's going to happen. But what we're going to do now is we're going to analyze 3 of the stocks that she mentioned right now. First off, Walmart. Let's pull up good old Walmart. Now, the reason I like talking about Walmart is it's a basic business. And over the next few years, Walmart is expected to grow thanks to its booming online sales, its powerful advertising business, and, drumroll please, smart use of AI and automation to cut costs and boost profits. It's becoming more than just a retailer. It's turning into a tech-powered machine that can compete with Amazon while serving customers across all income levels. Now, we're going to look at the financials behind Walmart and determine the price to pay using our stock analyzer tool. So, the stock is selling for $114 per share. That's absolutely useless right now. We don't care about that. What we care about is the market cap. That's all the shares outstanding multiplied by the share price, $916 billion. Enterprise value, $1.09 trillion. That difference right there is debt. They have a lot of leases, etc., so I'm sure that's a big part of it. They generated $15 billion in free cash flow last year versus $23 billion in net income, which I don't like, but then I compare its 5-year numbers and realize $15 billion versus $13.8. It probably means that lately they've had a really big increase in capital expenditures to help grow their business. So I'm not as worried about the difference here. Okay, here's what I am worried about. 40 times earnings. Guys, it's Walmart. Yeah, I know it's going to grow a lot, but it's 40 times earnings. Look at its profit margin. 10-year, 2.45%. 5-year, 2.38. 1-year, 3.26. Guys, they make pennies on every dollar they sell. It's not a high margin business. Now, they could be getting in other areas that are higher margin, but 95%, 98% of the revenue comes from retail. This isn't going to move much, in my opinion. All right, returns on capital, pretty stable. Nothing insane. 11% basically. All right. And growth rate, revenue, 3.8% a year for the last 10 years, 5% for the last 1 year, 5.42 for the last 3 years. Now, guys, if this data feels overwhelming, you're not alone. It was overwhelming to me at one point. It's overwhelming to Warren Buffett at one point. Everybody is overwhelmed when they start. We're here to simplify this. So I want you to do me a favor. These key metrics are very important to understand. I made a cheat sheet, very easy for you. Click the link below, download it. It'll explain all of these to you and why they're important. So go do that, because I teach on YouTube to help people understand when they buy a stock, they are buying a piece of a business that is not taught very often elsewhere, especially on a channel of our size. And in a couple minutes, I'm going to show you the price that I would pay for the stock based on my own assumptions. Let's go take a look at these 8 pillars right now. All right. Cash flow's down, like I said before, probably because let's go look at their cash flow. Let's go to their cash flow statement. Cash flow is cash from operations less your capital expenditures. And look, 5 years ago, they were doing 10 to 13 billion in capital expenditures. Now they're doing 25. That is why their free cash flow is down. It's not up as much. Oh, they also had a big year in 2020. That's why also. It was Walmart, it was COVID. They had a big jump. So right there, I'm like, okay, I'm not worried about it. Doesn't bother me. Let's go back to the 8 pillars. A little bit of extra debt. Again, they're retail. They have these leases. I'm not worried about that. It's these metrics right here. 5-year PE and 5-year price of free cash flow. Remember, the good news is, if that's our biggest worry, we just have to wait for the price to fall and the fundamentals to get better. That's easy. We can do that all day. That's what I want you to remember. Being patient. So what do analysts think about this company? 50% growth in earnings per share for the next 5 years. That's not a ton. Basically 10% a year. And revenue growth, 4, 4, 4, 6, 3. So between 4 and 5%. Nothing to write home about, but that's not what we need. We don't care about that. A great company that's growing like crazy, if you overpay for it, you're not going to do well. A boring company like this, if you pay the right price, you're going to do very, very well. So we take the stories, we take the numbers, we put it into Stock Analyzer tool. This is the tool that we use to sit there and say, okay, what's a reasonable range of prices? We make low, middle, and high assumptions. I'm using a 10-year analysis. You can do 1 to 20, but this is really important to understand. So guys, first line, revenue growth assumptions for the next 10 years. I did 2.5, 3.5, 4.5. Might be low. I'm fine with this. Profit margin. I did 2, 2.5, and 3. And I did 2.5, 3, and 3.5 for free cash flow, because free cash flow in the last 10 years was slightly higher. It's been taking a hit lately. Guys, I can understand this being low because of this, but this is only 1 year number. I don't know if that's the future and forever. I'd rather be conservative here. The last 5 and 10 years was 2.5%. I'd rather stick to that. Next, what is the PE and price of free cash flow 10 years from now that Walmart deserves? Guys, it's a high quality business. It's in everybody's life. Tons of people go to it. I mean, it's a premium company. You always start at 15 to 16, which is the market average. Go higher for good companies, lower for bad companies. I would consider this a better company. I put 17, 20, and 23. And then finally, I had 15% in here, but that's not what I'm doing. I'm trying to figure out what's the company worth intrinsic value. No margin of safety. Now remember, if you want to own this company, you got to have margin of safety. Why? Future's unknown. And we're humans and make mistakes. If you only want 9 or 10%, go buy a low-cost ETF. So I hit the Analyze button. The stock's currently at 114. Okay. Low price of 30 to 35, high price of 60 to 70, middle price of 40 to 50. Even if I went back up here and I changed my assumptions on revenue growth to 3, 4, and 5% and profit to 3, 3.5, and 4, what does it make my numbers? Not much higher. So I look at this saying, it's just overpriced. And I'm okay with that. I would rather wait until the stock is a lot lower to buy it at the right price. That's what good, successful investing is all about. Now, something very important, especially in this market, Most investors lose money because they're trying to pick the next big winner. The best investors do the opposite. You eliminate the losers first. That's what we're doing here when we analyze a stock. And the biggest losers are always based on valuation. So, stock number 2, Tesla. Oh boy, good old Tesla. I'm gonna go on a limb. I've said this before. I believe Tesla will be selling for less 10 years from now than it is today. Over the next 5 years, Tesla has massive dreams. Robotaxis, humanoid robots, becoming more of an AI tech company than just a car maker. But in the short run, they are still a car company, no matter what anybody says. There is huge upside if Tesla can pull off all its other goals, but there are also real concerns. EV is slowing. We would have never thought that before. Why? Tough competition now. Guys, when it was just an EV company, people said, EV's changing the world, don't bet against it. Then all of a sudden, what happened? A bunch of competition showed up, as Michael Burry says. Then it became a software business. Software didn't do very well. They did it for $12,000, didn't work. $8,000 didn't work. $99 a month, and then you get 2 months for free, or 3 months for free. And then guess what? Less than 2% of people signed up for it after the 3-month trial. That is not a software business. But now that's moved on. Now it's just a robotic humanoid business. Okay, sounds good. Now, back in the day, I used to chase the flashy stuff like Tesla, but I learned the hard way. If you don't understand what you're buying, you're not investing, you're gambling. So let's dig into Tesla's financials and understand what we are buying. And we use our stock analyzer tool to figure out what to pay. So, a car company that does $95 billion in revenue, getting $1.5 trillion market cap. Guys, this is the main metric I want to show you. Price to sales ratio. Why do I want to talk about this? Well, over 90% of Tesla's revenues are from cars. Ford, GM, Honda, Volkswagen, you know what their price to sales ratio is? Between 0.3 and 1. This is at 16. This company is selling for 16 to 50 times more than the other car companies. Why? Because everybody says it's something else, it's something else. Great. Double their revenue, all come from something else. It's still a car company. It's still a blend of a car companies in there. You have to sit there and realize that. And guess what? I love Elon. I think he's a brilliant man. He's doing wonderful things. He has a terrible time of performing under his deadlines. He's always late to the game. Doesn't mean he's not a brilliant man. It just means, come on, we got to be serious about this. Let's go to the 8 pillars. A lot of X's, doesn't mean to avoid it. Diluting shareholders, not a ton. 300 times free cash flow in the last 5 years, 180 times earnings. Return on capital, actually higher than I expected, 8%. Cash flow's up, net income's up, revenue's up, debt is reasonable. Okay, nothing bad. Like, I'm not sitting here just going like, oh my, it's just evaluation metrics. Everything else, I'm like, okay, I'm fine with that. I can deal with that. Let's go to analyst estimates. Now, analysts have major upside in the earnings per share. $1.64 going to $8.73 in the next 4 years. That's big time growth. If this is true, got to pay a premium. But I want to remind you guys of one thing. In the last year, it's down 35%. Why? Because suddenly people hated Elon Musk. And people didn't want to buy Teslas anymore. And the same left-wing wackadoos who loved him before, when they realized he wasn't a left-wing wackadoo like them, they stopped buying his car. This is what I mean, guys. 6, 7, 8 years ago, if I told you that they'd be struggling to beat sales on a year-over-year basis, you'd been like, there's no chance. That's what happens. I want you to remember, we're going to run the stock analyzer tool. Whatever we see, if it's all green, get excited. It's an opportunity to look more into a company. If it's all red, get excited. It's an opportunity to move on and find another company that you love. This is not about good or bad. Nothing in this world is just in and of itself good or bad. I look at this saying, okay, let's go run the numbers here. Let's go put in our assumptions for Tesla. So let me pull up the last time I did Tesla. Guys, I did 10-year analysis, 6, 12, and 18% revenue growth. That's a lot, by the way. Profit margin, 8, 12, and 16. Why is this a lot? Well, only one of these numbers is actually above the lowest number here. So I'm giving them major upside on the humanoid robot thing, the software, everything. I'm still giving them upside to that. PE 10 years from now, I'm going to put in 18, 21, and 24. Now, don't be the idiot like meet Kevin who says, well, it's currently selling for 200 times PE, so a 70 is a discount. You're an idiot. You start at 15 or 16, go higher for good companies, lower for bad companies. 18, 21, 24, 9% return. The stock's currently at 440. I have a low price of 46, high price of 290, middle price of 123. And guys, remember, that's with what I consider to be aggressive assumptions on revenue growth and profit. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. Now guys, stock number 3, D.R. Horton, the largest home builder in the country. Over the next few years, it's expected to grow slowly but steadily, helped by long-term housing demand and a possible rebound if interest rates ease. It's a solid business. Now we're going to break down their financials and use our stock analyzer tool to see what I would be willing to pay based on my own assumptions. Now, guys, there is a lot of speculation out there that we don't have enough supply of homes. And we see that sometimes with, look, I'm in the Cleveland market. And Cleveland's not a growing market. It's flat in population for the last 25 years in terms of the MSA. And guess what? You put a house up for 400 grand, it is selling immediately, very quickly. Even 600 grand, they're selling very quickly. There are suburbs in Cleveland that are middle-class suburbs, upper middle-class suburbs where homes, you can't find a home for under $500,000 for sale. That's in Cleveland. There's potentially a big supply problem for homes because we had a shock in interest rates. But now, good old Trump is trying to force that rate down a little bit. So, it's a $46 billion company that generated $3.28 billion in free cash flow last year. It has bottom line margins, 10-year margin, 12.3%, 5-year, 13.78%, 1-year, 10.5%. Probably because of discounts to get rid of inventory. These companies are all about churn and burn. Look at this though, PE of 13, price to free cash flow of 14. One of the best stocks ever. One of their competitors, NVR, just keeps buying back its shares. That's what makes it an amazing business. These home builders always sell cheap, and they buy back their shares, they can really increase the value. Return on invested capital, not the greatest last year, 8%, but 12.76 in the last 5 years, not bad. Now, I don't know their business model exactly. NVR, they're very big on, we will help an owner buy a piece of land, develop it, and then we'll buy the lots from them on a certain price as we sell them. So very little money out of their pocket at any given time. I don't know that D.R. Horton is doing the same thing. Let's go look at their 8 pillars. Wow, surprised by this. Oh, look at this. I didn't realize that. Their 5-year free cash flow is $2 billion. Their 5-year net income is 4.6. It's a big difference. Have to understand why that is. Need to understand why that big difference. That's over a 60% difference right there. I do not like that. But everything else is a check mark. Ooh, buying back those shares. 18% of their shares in the last 5 years. What do analysts think? Wow. Doubling their earnings per share, 12 to 27. Over double in the next 5 years. And revenue growth? Down 8%, 1%, 6%, 8%, 17%, 5%. All right. Sounds about right. Now, guys, it's our stock analyzer tool. I've never run stock analyzer on D.R. Horton. So you're going to watch me do it live in person. Okay. Revenue growth. I'm going to do 4, 7, and 10%. Profit margin. It's down a little bit, but I'm okay with that. I'm going to go with 11, 12.5, and 14%. Free cash flow margin. Boy, it's a lot lower. I don't like that. Like for me, guys, immediately because of that, if I don't understand why that is, I'm out. That's my opinion on it. So I'm going to sit here and put 6, 8, and 10%. Now, what PE would I put? I'm going to put in 14, 17, and 20, and then a 9% desired return. Hit the analyze button. The stock's currently 156. Oh, wow, look at this. That's interesting. Even on the low free cash flow, low price of 110, high price of 361, middle price of 205. Very interesting. Keep buying back your shares, guys. So guys, I know the stocks we looked at today, we're very mixed on stock analyzer results. And that's actually a good thing when you find stocks to avoid because it means you're not wasting time or throwing your hard-earned money at overpriced hype. But here's the fun part. Just recently, I just did a video where 5 stocks lit up all green. So click the video on your screen and I'm going to walk you through each one. I'll see you there.